Good afternoon and a very warm welcome to our Lunchtime Dial-In. It's great to have you with us today, whether you're here listening live or catching up with the recording later. We're looking forward to sharing the latest developments and updates for churches and Christian charities with you. And we hope that this session will be really helpful. My name is Sarah Crispin and I am Senior Accounts Examiner at Stewardship, and I'll be your host today. I'm joined by three of my colleagues: Stephen Matthews, Senior Consultant, Archie McDowell, Head of Accounts Examination Services, and Rachel Steeden, Head of Legal. For those of you who are new with us, our mission at Stewardship is to transform generosity by making giving easy, inspiring greater generosity and strengthening Christian causes. These Lunchtime Dial-Ins are just one of the ways we aim to support and strengthen our church and Christian charity partners. If you're interested in finding out more about the ways we can support your church or charity, you can check out all of our services and resources on our website, or do feel free to call our customer services team. They would love to speak to you. The number is on your screen now, and it will also be sent out in the follow-up email later today. If you'd like to make sure that you receive the follow-up emails, including the recording of this session, you'll need to ensure that you're signed up to the Dial-In mailing list. So if you haven't done so yet, please email us to find out how, and we will send you the link. So moving on to today, we'll be covering the following agenda items. Firstly, can spouses reallocate their giving for gift aid? Then 5 things not to do until you've taken professional advice. More accounting changes on the way. Making the most of non-cash giving. And finally, a manse. Is it a benefit, a blessing, or a tax liability? And we'll follow with our usual Q&A session at the end. If you have questions today, please do use the chat function to ask them, and we'll answer as many as we can in the time we have together. If you haven't joined us before, the instructions for doing that are on the screen now. But before we get started on our agenda, let's just pray together. Heavenly Father, we thank you for the time we have together today to update our knowledge and strengthen our Christian causes. We thank you for each of the organisations represented here today. And we pray that what is shared will give insight, knowledge, and confidence, and that we would be good witnesses for you in our work and our communities. In Jesus' name, Amen. So first up, we have Rachel, who's going to talk about, can spouses reallocate their giving for gift aid?
Thanks, Sarah. So recently on our consultancy helpline, we've had quite a few questions from treasurers, some of you joining today, welcome, around giving by spouses and whether giving can be reallocated between spouses for gift aid purposes. Perhaps because one spouse is a taxpayer and the other isn't, or perhaps because one spouse pays tax at a higher rate than the other. So what are the principles here? I'm sure you know that gift aid applies if a UK taxpayer completes a gift aid declaration and pays enough income or capital gains tax in that tax year to cover the amount which your church or charity will reclaim from HMRC, plus any higher or additional rate relief the donor will reclaim through their own tax return. Now, in assessing whether the donor has paid enough tax to cover the gift aid, HMRC looks at the tax paid by the individual, not at the tax paid by the whole family unit. Second principle, donors must donate their own money. So the individual must be giving their own funds and cannot gift aid money collected from family, friends, or work colleagues, or money raised from fundraising activities or funds given to them by others to give to charity. However, HMRC's guidance covers 2 specific points which are helpful for churches receiving gifts from spouses. Firstly, HMRC permit joint gift aid declarations from spouses. This joint declaration must include the full name and address of each person. So in effect, it's 2 gift aid declarations which are given on 1 piece of paper for your administrative convenience as the treasurer. However, HMRC states that the donors must tell the charity how much of any donation relates to each of them. So you still need to know who your donor is. Second piece of HMRC guidance is that if a donation comes from a joint bank account and only one of the account holders has given you a gift aid declaration, the charity can assume that the donation came from the account holder who made the gift aid declaration. This applies even if the donation is authorised by the other account holder. So, for example, if you've got a gift aid declaration from the husband, but you receive a cheque signed by the wife from their joint bank account, you can assume that it's a gift from the husband who's given the gift aid declaration. So what should treasurers do in practice? We would encourage you to educate your donors about gift aid and the potential advantage of couples agreeing between themselves that the spouse paying the highest rate of tax will do all of the family's charitable giving out of their own funds. If you receive a gift from a joint account, you can follow HMRC's guidance and allocate this between the spouses as the spouses request you to, assuming that the donating spouse or spouses have given you a gift aid declaration. If you're being asked, however, to reallocate a donation on which you've already claimed the gift aid, you'll probably want to talk to HMRC first. If you receive a gift from an account which is in the sole name of one spouse, we don't believe that the HMRC guidance would permit you to treat this as a gift from the other spouse. We're drawing a distinction there between sole and joint bank accounts, which we think is quite important. Gift aid is a very valuable asset for charitable Christian ministry. We want to use it wisely, with diligence and safely. So let's pay to Caesar what is Caesar's and claim from Caesar that which has been generously given to us to reclaim.
Thanks, Rachel. That was really informative and practical information. And as a reminder, if you have questions on that, please do be putting them into the chat. Our next item today is Stephen, who's going to talk about 5 things not to do until you've taken professional advice. Thanks, Stephen.
Thank you, Sarah. Now, at Stewardship, we see a lot of church accounts, hear a lot of questions, and receive what regulators such as the Charity Commission and HMRC have to say. Some common themes emerge, and we want to share some of those with you. We want to see the church in the UK fulfill its mission effectively, generously, and with the character that Christ displayed in his ministry. We also want to help churches navigate the complex areas of governance, charity law, and taxation in ways that the Apostle Paul did when he urged the Corinthian church to do what's right, not only in the eyes of God, but also of men. We've set out 5 areas where we commonly see churches get into a tangle, and we believe that taking some advice in advance would avoid a lot of the grief later on. These are 1, retirement gifts, leaving gifts to ministers or trustees, giving money to volunteers and paid roles to trustees, helping a minister or missionary buy a property, giving large amounts overseas, and returning donations once they've been given to you. Now, let's look at the first of these. Gifts of money, which are often at retirement or after long service, to those that serve the church either as staff or as trustees. As churches, we often have a strong desire to thank, acknowledge, and appreciate the way that people have served us. We often have strong relationships and want to allow others who have developed respect, friendship, and affection to be involved. This often is thought about in terms of leaving gifts, which at times can be substantial. Because of the relationships we have, we can make the mistake of simply thinking this is just a gift and there are no other consequences without thinking about the background. Now, first background is churches are nearly always structured as charities. Charities cannot just give money to people because they like them. There must be a valid charitable reason for a payment from the charity. Secondly, paid leaders are very often employees as well, sometimes office holders. There are tax, national insurance, and other implications when an employer, the charity, makes payments to its workers. Thirdly, charity law limits payments to trustees or connected parties, like close family. Very often not allowing any, sometimes permitting them as part of a pre-approved contractual arrangement. And the Charity Commission revised their guidance in April this year, just a couple of months ago, and refer to certain size thresholds, which can be quite low, e.g. £1,000, or for charitable companies as low as £200. So you should read that. The second area is about giving money to volunteers or paid roles to trustees. And the second is like the first. It's about paying people who serve. With volunteers, it's easy to think we should honour them with gifts, provide them a little something to recognise what they do. The very real danger, and we have seen it occur in practice on a number of occasions, is that these payments, even small ones, change the status of the worker from that of a voluntary worker to that of a paid worker or employee, which brings with it a lot of rights and obligations. Most critically, the obligation to pay the national minimum wage for every hour worked, regardless of whether the worker actually wants it or not. And with trustees or their connected persons, the starting point for any payment is no, there can't be. Even when there are permissions, the wording is nearly always complex, nuanced, and needs to be read and followed carefully if you are going to make a payment. We've seen many cases where the church has said, we're allowed to pay, and the commission or a charity lawyer has said, oh, no, you can't. Common examples include the permission to pay for goods and services does not automatically permit paying someone a salary. So if you look in your governing document, your constitution or memorandum arts, and it says you can pay for goods and services, it does not mean by those words you can employ someone. Secondly, the permission normally depends on what the trustees going through a proper exercise and documenting that process. And very often when we deal with these questions, we find that they haven't done that. So you need to read your governing document carefully and follow it. There are ways that mistakes can be rectified, but these are nearly always a lot of hassle and are always embarrassing. 3, helping a minister or missionary to buy a property. Some churches will want to help their ministers or charities, their mission partners, to buy a property in their own name to give them a secure home and provide for their retirement. Both good things. However, Christian workers, for various reasons, may well find it difficult to get a sensible mortgage. Therefore, it makes it doubly difficult. So we think about lending or giving them money from the church or mission charity, and we say, surely that's okay. But remember, a loan from a church to a worker could well have employment tax implications. Secondly, shared ownership between the church and the worker is complex, especially if the worker wants to move away or change church, creates lots of issues. And thirdly, making a gift to help with the purchase of a house is unlikely to be charitable per se because of the private benefit to the individual rather than public benefit. So if you're thinking of doing any of these things, please do talk to specialist providers such as Christian Lender Kingdom Bank or Christian Shared Ownership Facilitator Mission Housing and provider of housing for returning missionaries, the Whitefield Christian Trust. 4, giving large amounts overseas. This is on the list because there are both special risks and specific regulation when grants are made overseas. The risks lie in the different environment in which the money will be held and used. These range from simple cultural understandings through ability to see what is happening, legal issues over ownership, and all the way through to potential misuse for terrorism. The specific regulations are about tax, where HMRC have special requirements to enable them to treat the amount paid overseas as charitable expenditure, which, if not in place, means that the paying charity is taxed in the UK on that expenditure overseas. Now, there are a lot of different issues and lots of good guidance to help in advance. The Charity Commission have very good guidance on how to identify and manage risks, handle money safely, and protect your staff and beneficiaries overseas. Stewardship have a free briefing paper specifically for churches about making payments overseas and a number of blogs, and we're sending out the links in the final email at the end of this call. There are many Christian charities who found themselves with unexpected difficulties when what they thought was simple has turned out to be anything but. It is important that leaders and trustees do background research and also learn from those that have done it themselves. Some actions can be as simple as paying small but regular amounts rather than a large amount up front, arranging to pay suppliers to the project rather than to the overseas body or NGO that is being supported, establishing who owns what and the details of who manages things overseas. Is the way they do safeguarding suitable? What feedback are you expecting from them and how often? And do you need to visit, actually get on a plane and go over there and see? And what sort of documentation on this is right and helpful? Much of this is worth getting agreement at an early stage, so there's less chance of any misunderstanding with a connotation of, don't you trust us? We do want the love and generosity of God to be for the world and not just the UK. However, there is a maxim that is true in this area, I think. It's better to learn from others' mistakes than your own. Finally, returning a donation. Sometimes it's obvious that a donation should be returned. For example, when a donor makes a duplicate card payment by mistake. But there are many more difficult situations. For example, a grant comes with a restrictive condition, e.g. for something you don't really want to do. Where a family complains and you discover the gift has left a donor in financial difficulty. Or more usually for ministry charities rather than churches, where the monies come from a bad source. The starting point in law is that a charity should accept donations given to it. Personal considerations, objections, or preferences should not necessarily dictate a charity's decision. And once a charity has accepted a donation, there is a very high bar to overcome before you can return it. This is where we'd encourage you to take professional advice. Of course, prevention is better than cure. So we do advise churches and charities who may face this to have a clear policy setting out how difficult donations will be handled and what donations will be accepted or refused. We've got a recent blog on this called How to Deal with Tricky or Challenging Donations. Now, we aren't in the business of getting churches to pay loads of money to lawyers and professionals, but there are some areas where advice in advance is very helpful. I hope those 5 have been. Thanks.
Thank you, Stephen. That was really helpful. Now, Stephen did mention a number of blogs and briefing papers while he was speaking. And just to reassure you that those will be in the final email that we send to you, so that you can follow up on those and also any others that are mentioned during the course of this webinar. As a reminder, if you've got questions, please do add them to the chat. So now Archie's going to update us on accounting changes which may be on the way. Thank you, Archie.
Thank you, Sarah, and good afternoon, everyone. In our last Treasurer's Dial-In back in February, we highlighted that a new charity SORP was on the way, with changes taking place with effect from accounting periods beginning on or after 1st January 2026. The new SORP is currently still out for consultation, which will end at the end of June, with the final details available in the autumn, and these will be covered in a future dial-in. However, the new SORP is not the only change about to come along. The government also announced some weeks ago another consultation, this time around financial thresholds which are contained within charity law in England and Wales. The Scottish Government recently announced that the income threshold below which Scottish registered charities will be eligible to have their accounts independently examined rather than audited will be increasing from the current level of £500,000 to £1 million when the revised Charities Account Scotland regulations are published in autumn 2025. This, of course, brings the Scottish charity sector into line with England and Wales, or at least it would have, but no sooner had that change been announced when the consultation to increase thresholds in England and Wales was announced. For the sake of completeness, I should probably also say that we're not aware of any plans to increase the thresholds for charities registered in Northern Ireland. The final details of the changes in England and Wales will not be known until after the consultation closes. But it does seem very likely that a number of thresholds will be increasing. It's not only the income threshold for audit which is likely to increase, but also the gross asset threshold, which currently often means that charities which do not breach the income level might still be required to have an audit because of the value of their assets. A factor that will be exacerbated by the changes to lease accounting contained in the new SORP. Other thresholds which are being considered for change in England and Wales are the income levels at which charities are required to register with the Charity Commission, the level at which they have to have their accounts independently examined, or are eligible to prepare receipts and payments accounts, or at which they require to have their accounts independently examined by someone who's a member of a recognised accountancy body. When any changes are finalised, we will of course highlight those changes in Sharpen and in our briefing papers. But in the meantime, there are a number of things which a charity which is maybe about to breach the current thresholds should maybe think about. In particular, if a charity currently prepares receipts and payments accounts, it might not be necessary to switch to accrual accounts if the income is expected to exceed £250,000. And also, those charities which are currently only just over the income or asset thresholds for audit may well be able to revert or continue to have their accounts independently examined. It's also worth saying at this point that here at Stewardship, we have seen a number of situations where charities have gone above the income or asset thresholds for audit, due maybe to a one-off out of the ordinary event, and have successfully applied for a dispensation from audit from the Charity Commission. It may be that as the thresholds are currently under review, that it makes even more sense to ask for a dispensation from audit. It's certainly worth thinking about. So, lots of change coming over the next few months, and hopefully things will become clearer soon. And with that, it's back to Sarah. Thank you.
Thank you, Archie, and we will, of course, keep you updated in future dial-ins as well. Now, Archie mentioned Sharpen there. For those who don't know, this is our quarterly email for trustees, treasurers, and church and charity leaders. It contains practical tools, technical resources, and expert guidance to safeguard your mission and ministry. So if you want to sign up for that, that's also possible on our website. Rachel's now going to give us an insight on how to make the most of non-cash giving. Thank you, Rachel.
Thank you, Sarah. So I'm sure you're all aware of gift aid and the opportunity that provides to boost cash donations to your church or your charity. But today I'd like to talk to you about a much less well-used relief, which is the relief for charitable gifts of land or buildings or listed shares. You can see from these statistics that this relief is used much less than gift aid and that the level has remained relatively static over the last few years. Now, I think this is a missed opportunity, and personally, I've very rarely heard this opportunity of non-cash giving mentioned by churches or charities. If you're approached by a donor who would like to give land, buildings, listed shares to your charity, there are two ways that you could facilitate this. Option one. The donor could sell the asset, pay any capital gains tax, and give you the cash proceeds. And then the donor can claim gift aid on their cash gift of the proceeds. So in effect, this splits the tax relief between you and the donor. You get the basic rate relief and the donor gets their higher or additional rate relief if relevant. Option number two, the donor could give you the asset itself. The donor doesn't have to pay capital gains tax because this is a charitable gift. And the donor can deduct the full market value of the asset from their taxable income. What does that mean? It means they get income tax relief at their marginal rate of up to 45% in England, Wales, Northern Ireland, or even higher in Scotland. So this is potentially a very generous relief. But how do you know which of those options is best for your donor? The answer is that you don't, because it depends on their personal financial circumstances. For example, do they have enough income to fully utilise the income tax relief for option two? So I would always encourage the donor to talk to their tax advisor. Now, the case study on this slide shows why option two, giving the asset, has become even more tax efficient over the past few years. The annual exempt amount for capital gains tax has been reduced by over 3/4, and the capital gains tax rate has gone up, so that selling assets for your own private gain has become a lot more expensive. So in my example here, Carol can now sell her £40,000 of listed shares at a capital gains tax cost of £4,080, leaving her with £35,920. Or if she gives them to charity, she pays no capital gains tax and she achieves an income tax deduction of up to £18,000 or even more if she's in Scotland. So Carol's gift of £40,000 effectively costs her as little as £22,000. So you can see that if Carol is inclined to be charitable, this is a really effective way to boost her giving. So how do you administer a non-cash gift? If you're planning to sell gifted land or buildings in England and Wales, please remember that you will need a Charities Act report on the valuation of the land and the method of sale. Now, you might be able to use a declaration of trust or a nominee declaration by your donor so that the donor can sell the land on your charity's behalf, and you don't need to convey it firstly from the donor to your charity and then secondly from your charity to the buyer. This would save you time and transaction costs. Sadly, doesn't seem to work in Scotland. Now, for a gift of listed shares, you can use an exchange of letters in which the donor offers the shares, then your charity accepts the gift and asks the donor to sell the shares on your behalf. Again, this saves time and it saves transaction costs because you don't incur broker fees for moving the shares from the donor to your charity. Alternatively, your donor could use a charity called share gift or could transfer the shares themselves in specie from their account to your charity's broker account. Now, if all this sounds too complicated, please don't worry. At Stewardship, we handle these gifts every week, and we would love to help facilitate your donor's non-cash gift for you. We can receive the non-cash gift from your donor, we can have the asset sold, and then we can make a grant to your Stewardship partner account in the usual way. Finally, how can you ensure that your donors are aware of this opportunity? We'd love to encourage you to include non-cash giving as an option when you talk about giving, when you create giving leaflets or web pages. And you're also very welcome to share our donor-facing blog about non-cash giving, of which there's a snip here, and we'll send it out by email after this dial-in. Back to Sarah, thank you.
Thanks, Rachel. That's really helpful. So finally, we have Stephen back, and he's going to be talking about manses. Are they a benefit, a blessing, or a tax liability? Thank you, Stephen.
Thanks, Sarah. Now, we have a long history in the church in the UK of church leaders, ministers, pastors being provided with manses or vicarages as part of the job. We're also used to of them being free of tax. So there is no taxation on the church or the individual because it is being provided for the better performance of the duties. Now, where a minister is provided with the housing for the better performance of the duties of the office, and it is customary for living accommodation to be provided for such ministers, which is usually referred to as job-related accommodation, the value of the accommodation provided is not taxable. This privilege has been a long-established practice and is very valuable in many situations. However, with the changing face of housing and of church in the UK, the traditional situation of an employed minister in a church-owned manse is not always a likely solution. There are three issues we see that churches are not thinking about in advance. One, is the nature of the role one that meets the definition of a minister? Two, is the property one that meets the required criteria? And three, what expenses on the house can be paid free of tax? Let's look at the first disease, the nature of the role. The exemption from the normal taxation rule is based on the role that of a minister of religion. Not every church worker is eligible. They don't have to be ordained clergy, but they should have pastoral responsibilities like that of ministers. Administrators, youth, or community workers are not in, unless their roles clearly have a major element of pastoral responsibilities. Secondly, the property. It's not the property itself that is the question, but the legal title or legal interest that the church has in it that is important. The church should either own the property or, if it is leased, be the tenant. It is not enough just to pay the rent, e.g., if the tenant is the minister themselves and the church pays or reimburses the rent. This would not fall in the exception. If this were the situation, the rent paid is effectively extra salary and taxable in the normal way. This is the same if instead of rent being paid, the church paid a minister a housing allowance. This is just another element of salary and would also be taxable in the normal way as any other part of salary. Thirdly, the expenses of the house. Presuming the house does fall within the exception, then normally the council tax, water rates and core repairs and insurance for the fabric of the building would fall to the church. However, if the church bears the cost of ongoing internal decoration or repairs, replacement carpets and similar, you cannot presume that these are all exempt. Similarly, gas electric bills would normally only have an element. That's the part required for the business activity, that element, which could be funded by the church without there being taxation involved. There is a very useful guide produced by the Baptist Union for their ministers, which is very helpful for any church considering this for the first time. We'll send that out at the end of this, a link to that. In conclusion, these are only 3 of the aspects we see where churches could misunderstand the scope of the exceptions. Being able to provide a manse to your church minister is a fantastic blessing and benefit. So please do not let this become an unexpected tax liability by jumping in without thinking. The advice is think about these things first and do not presume they're automatically exempt from tax. May this be a blessing and not a tax liability. Thanks.
Thank you, Stephen, very much. And as Stephen mentioned, there's a blog on this topic, and the Baptist Union guidance, and we'll include links for those in the follow-up email code, which will take you to our website, and all the resources will be there as well. As mentioned at the beginning of this session, there are many ways that we aim to help churches and charities navigate their governance responsibilities. And 2 of particular interest for you as our audience here are our consultancy helpline, which is an affordable annual subscription. You can ask your questions on a range of topics, and one of our consultants will be on hand to support you. And our resources section on the website. Here you'll find mostly free resources, including all of our briefing papers, not just those mentioned today, on a variety of topics, as well as blogs on current issues. Links in our follow-up email, and the QR code on this slide will also take you to those links. And if you're signed up to the consultancy helpline, remember to make use of that as well. The follow-on email will include a very brief survey, and that should take no more than 3 minutes to complete. We really appreciate hearing from you, and your feedback and comments are always reviewed to improve our events. If you haven't responded for a while, please do take the time to let us know what we're doing well, and also if there's anything else that you'd like us to include. We really appreciate your time doing that. Our next dial-in will be on Thursday, the 6th of November, 2025, and we do hope you'll be able to join us then. Please do pass on the invitation to anyone who you know may be interested. So finally, a big thank you again to our panelists, Stephen, Archie and Rachel, for sharing their expertise and for answering your questions. And thank you to you as well for joining us today and for the great questions that you put forward. We hope the rest of your day goes well, and we'll continue to pray for you and your organisations that you'll be equipped to serve faithfully and be a blessing to those that you serve over the coming months. Thank you very much.